for me, it's just banks, money, and business. That's it.
Fun. Bookkeeping. Sadness.
I cannot balance it.
Money.
Accounting, definition, history, functions, types, and more. First of all, what does accounting mean? Accounting is the systematic and comprehensive recording of financial transactions pertaining to a business. It also refers to the process of summarizing, analyzing, and reporting these transactions. In addition, it is also called the language of business due to the fact that it is used to communicate financial information. Part 1. History of Accounting. The modern field of accounting was established by the Italian mathematician Luca Pacioli. His first work on a double-entry bookkeeping system was published in Italy in 1494. The history of accounting is thousands of years old and can be traced to ancient civilizations. Accounting was born before writing or numbers existed around 10,000 years ago in the area known as Mesopotamia, later Persia, and today the countries of Iran and Iraq. There is also evidence for early forms of bookkeeping in ancient Iran and early auditing systems by the ancient Egyptians and Babylonians. This area contains the Tigris-Euphrates River Valley, a large fertile area 10,000 years ago with a large thriving population and an active trading between towns and cities up and down the two rivers. Writing and numbers would not be invented for about another 5,000 years. And what happens next will directly lead to the invention of both writing and number systems. At that time, merchants faced many of the same problems businesses face today. They had to ship their merchandise up and down the rivers, and that meant trusting a boatman with their goods. Unfortunately, not all boatmen were honest, and disagreements often arose about how much was shipped versus what was received at the other end. The words accounting and accountancy were used in Great Britain by the mid-1800s and are derived from the words accompting and accountantship used in the 18th century. Part 2. Functions of Accounting. There are 4 functions, namely recording, classifying, summarizing, and interpreting. First, we have recording. Also known as bookkeeping, it is one of the basic functions of accounting. This means to put the transaction to writing in books of accounts and ensures that all business transactions of financial characters are in fact recorded. Secondly, we have classifying. This is the process of grouping of transactions or entries of one nature at the place. Involves sorting and grouping similar items under the designated name, category, or account. The work of classifying is done in the book termed as ledger. Third, we have summarizing. This is the summarization of data after each accounting period, such as a month, quarter, or year. Graphs and other visual elements are often used to complement the text data. It involves presenting the classified data in a manner which is understandable and useful to management and other interested parties. It also involves the preparation of at least 2 statements, trading and profit and loss account and balance sheet. Lastly, we have interpreting, which is the final function of accounting, which concerns with analyzing financial data. It is a critical tool for decision-making. The recorded financial data is interpreted in a manner that the end users can make a meaningful judgment about the financial conditions and profitability of the business operations. Part 3. Types of businesses. First, we have the service business. It provides intangible products, which are products with no physical form. It offers professional skills, expertise, advice, and other similar products. Examples are schools, salons, and banks. Second, we have merchandising business. It buys products at a wholesale price and sells the same product at retail price, also known as buy and sell businesses. Examples are groceries, convenience stores, and distributors. Lastly, we have manufacturing business. Buys products with the intention of using them as materials in making a new product. Combines raw materials, labor, and factory overhead in its production process. The manufactured goods will then be sold to customers. Part 4. Types of ownership. First, we have sole proprietorships, wherein a business is owned by one person. Advantages would be starting is easy to do. You get to make all of the decisions of the company and keep all the profits. Disadvantages would be unlimited liability, wherein the owner is responsible for all debts, and the owner may not have all the skills to run the business. Second, we have partnerships. It is a business owned by 2 or more people wherein a partnership agreement is required. Advantages would be easy to start, easier to obtain capital, and each partner brings different skills to the business. Disadvantages would be all partners share the risks. If one leaves, the remaining partners have to reorganize, and partners share unlimited legal and financial liability. Lastly, we have corporations. It is a company that is registered by a state and operates apart from its owner. Advantages would be owners have limited liability, ability to raise money through stock, and the corporation does not end when the owners die. Disadvantages would be double taxation and difficult and costly to start the corporation. And that is it. We do hope that you have learned a lot of things in this video about accounting. And always remember, bookkeeping can help in your business life and personal life.